Instead, would you please call the roll?
Yes, Chair. Director Pacho.
Here.
Director Taylor. Director Guzman. Director Scholas. Director Heller. Mr. Davis.
Here.
Ms. Chauncey.
Here.
Mr. McBool.
Here.
Chair, we do not have a quorum, but we may start with the first presentation item.
Okay. We have two presentation items by Kwaku Obed with Marquette and Associates. The executive summary of September 2022 market performance and the asset allocation transition plan. Mr. Obed, would you please proceed?
Sure. Good morning, everyone. So we'll start with, as the chairman mentioned, an overview of the economy. So as usual, we'll give some comments regarding the macro environment that we're in. So this is a pretty busy exhibit, but the takeaway here is, if you look across all the various asset classes, this is a periodic table. And what we essentially do is we rank the best performing asset classes on each calendar year basis. And you can definitely see in 2022, it has been a really good environment for commodities, real estate, and then everything else has really been in negative territory. So, far left-hand side, 2022 year to date, once again, two asset classes on the top are positive, everything else is negative. The third best performing asset class in 2022 year to date through the end of September is bank loans, down 3.3%. So it really just gives you a sense of how much carnage there is in the marketplace. Further out to the right-hand side, the real takeaway here is having a diversified program makes a lot of sense for a long-term investor. As we go further out to the right-hand side, you'll see certain asset classes outperforming one year, but then subsequent years underperforming, which again really just reinforces the benefits of asset allocation and diversification. So as we think about the challenges that the market has faced in 2022, one of the biggest headwinds has been inflation, CPI, the Consumer Price Index. That has really ticked up to generational highs. To give you a sense of where CPI is relative to what we normally see, 2% would be considered a normal baseline for CPI. So back before COVID and the stimulus spending, CPI around 2% again would point to a normal type environment. Anything under 2 would point to a contractionary environment, and then anything above 2 would point to an inflationary environment. This is the highest figure again we've seen in well over 40 years, so 8.3%. A couple of key drivers behind this, stimulus spending. Once again, if you think about stimulus spending through the CARES Act, that increases the money supply in the economy. An increase in money supply will have inflationary pressures, but then that's been exacerbated by the supply chain disruption. Supermarkets, Home Depot, just basic things are less easy to come by today. And then we also have the Russian invasion of Ukraine that had the impact of really boosting up oil prices, commodity prices. So that in itself has had significant inflationary pressures in the economy, and the inflationary pressures followed by the Fed action of raising interest rates has really just increased the volatility that we see in the marketplace. So when we look at the fixed income asset class, fixed income has been very sensitive to inflation because this is a fixed asset. So any fixed asset will be more sensitive to inflationary pressures, but it's also had the double whammy of having interest rates moved up. So the Fed has raised interest rates. What's the rationale behind that? To control inflation. Well, when interest rates are low, it's easier to borrow, it's easier to spend. That has inflationary pressures inherently with it. When interest rates go up, it becomes less easy to borrow, and that does slow down consumer behavior. So that has really been the Fed's mission to control this inflationary pressure we're seeing through very aggressive rate hikes. Those very aggressive rate hikes have been negative for fixed income. There is a negative correlation between the returns of most types of fixed income and interest rates. So as rates go up, that value of fixed income comes down, and vice versa. When rates do come down, the value of fixed income comes up. So we take a look on this page and we're looking at returns down almost 15% for the fixed income asset class. So fixed income is in a bear market. Fixed income is struggling, and the reasons I just gave, inflation, interest rates, are the key drivers behind the struggles we're seeing in the fixed income market. Another thing that's worth noting here, and I guess the theme, I should have really themed this discussion before I jumped in. I think it is buckle your seatbelts, because it's going to be a rough ride, at least for the next 6 months, if not longer. One of the indicators here is the yield curve, and the yield curve essentially plots where interest rates are across different maturities in the fixed income market. The blue line points to interest rates as of September 2022. And the real interesting point here is the shape of the yield curve, right? So on the green line, when we go down to where rates were a year ago, that's kind of normal shaping. It's linear in nature, which means that for every period where you go further out, you expect to get higher interest rate compensation, right? So that's normal behavior of the interest rate curve. What we're seeing presently is an inversion of the yield curve, particularly around the 2 and 10-year maturity. Inversion of the yield curve, and you may hear about this a lot more, financial media, financial news. Inversion of the yield curve is typically a good predictor of recessionary activity, meaning that short-term prospects are viewed more bullishly than long-term prospects by the market. So again, an inverted yield curve is an indicator that we are definitely flirting with a recession. And on average, it's typically around 18 months between the inversion of the yield curve and when that recession does take hold. Before jumping into this meeting, I think there was, I don't know the source because it was just a headline that flashed on my phone, but something either in the Journal or CNN pointed to us being in a 1990 style recession around the spring of next year. So again, pretty tough going for the market. But as we continue to talk out the market and kind of the corner the Fed has boxed us into, a recession, unfortunately, seems to be the only way for the market to reset and kind of move on from this strange period that we're in. So U.S. equities have also been through a lot of pain in 2022. Year to date, for example, the S&P down almost 24%, mid-cap indices down 24%, and then small-cap indices down 25%. The big thing on this page is still the delta or the difference you see between core value and growth. So as we think about your value stocks, these are stocks of more established companies. Perhaps the market discounts what this company does or doesn't view what this value company does. View it as exciting as what a growth company would do. So I think a good example here would be Ford Motor Company versus, let's say, a Tesla. Ford would be a value stock, older car company, very established business lines. And then Tesla, newer, they have shiny new things. The market really hangs on the tweets and the goings-on of a dynamic or eccentric CEO. So those are the two differences between value and growth. The big takeaway here is in this type of environment, value stocks will typically hold up better than growth stocks because the market and investors are more concerned about cash flows, dividends, as opposed to long-term growth prospects. So that's pretty interesting takeaway from this page. Here, we just talk about the factors and sectors in the S&P 500. I mean, the big takeaway here is most sectors, with the exception of energy, were significantly down year to date. Going to the non-US equity market, reminder here that the pandemic, as well as the raising of interest rates, supply chain disruption, inflation, these are not just US problems. These are problems that many other economies across the globe are also facing. One area that's really interesting to point out here is the developed market indices, the MSCI EAFE, where we compare the year-to-date results of the EAFE index versus the EAFE local index. I always think this is a really interesting exhibit to look at because it points to just how the dollar is doing at any point in time. And if you look at the EAFE local index, these are the returns of your developed markets returns not translated into US dollars. So these are foreign currency returns giving you a negative 14.5% result year to date. However, if you convert or translate those gains into US dollars from that foreign currency, suddenly those losses have doubled. And that points to the strengthening of the dollar amidst this crisis environment that we're in. So that's not something we have to worry about within the US. We're obviously in the US, we pay everything in dollars, but the international markets are struggling with a healthy appreciation of the US dollar. So that's another challenge outside of the US that many economies are facing, in addition to the inflation, supply chain disruptions, and other things I mentioned. So let me jump ahead really quickly. Within the asset allocation, which we'll talk about momentarily, we will talk about, I should say, real estate and real assets, the benefits of real estate and real assets. This is just a quick spot check of how this segment of the marketplace is doing in 2022. The numbers through to the end of the second quarter point to a positive 12%. Compare that with the equity market that's down 24%. So again, hitting on the theme of diversification, correlation, real estate is definitely, in our opinion, a good asset class to have within a portfolio, particularly as we grapple with inflation and as we think about the extreme volatility that we've seen in the equity markets. Infrastructure is also another segment of the market that we are looking to gain some exposure to. And like the real estate allocation, we look at infrastructure actually holding up pretty nicely versus the broader market in this very volatile 2022. Private equity, another segment of the market that we're looking to add within the asset allocation. And the takeaway here again is, private equity has been additive in this very volatile environment. And once again, as a long-term investor, we feel that this is a segment of the market that will add value. So as we jump into the portfolio and the review of the portfolio, I mentioned before both US equities and non-US equities are negative. I've also mentioned that fixed income is negative. So when we look at the negative returns of the portfolio, it's not anything that we're doing, or it's not anything that has been missed. We're in an environment where everything is going down, and ultimately we are riding that downward trend in the market presently. So for the month of September, the portfolio was down 7.5%, a little bit behind the benchmark. Year to date, the portfolio down 20.4%. But it's important to really look at that right-hand side when we start looking at the 3, 5, 7, and 10 years, which is a reminder that as long-term investors, we still have very solid returns, very solid annualized returns going further out. But even more importantly, as long-term investors, at some point, the pain that we're going through in the market will be viewed as noise, for lack of a better term. The market does trend upwards more than it goes down. So in the boom-bust cycles of the economy, the markets, and so on, this painful period that we're going through will really, in our opinion, and typically on how the market behaves, pale in comparison to the upsides that we'll expect to see from the markets. Because again, the market does have an upward trajectory. I think the analysis here is it's like being on an elevator. If you think about mapping the behavior of the market, you think about an elevator that's going up, but then you think about someone playing with a yo-yo in the elevator, and that gives you the behavior of the market, where there'll be periods where you're still trending up. We're in an inflationary environment, so things are trending up, but the volatility will kind of bring things down to an unbearable level over the short term. But again, as long-term investors, we do anticipate good and strong returns coming from the market. As we think about performance, there aren't any surprises on this page. Again, we've mentioned. Yes.
Can you go back to the?
Yeah, absolutely.
So, how do you adjust the negative against the positive? You absorb the negative, and then the total accumulative is positive, right?
Yes, that's right. So over the entire long term, it is positive, but the positive numbers have come down. So this time last year, the 10-year figure would have been significantly higher because we didn't have the negative returns eating in. But yeah, at the end of the day, we do take this is a running tally of the returns of the portfolio.
Because right there you see, you have 17, minus 17 compared to after 10 years, 4.5. So that is a net gain of 4.5.
Yeah, exactly. The way to read this would be over the 1-year period, the portfolio has gone through a loss. However, over the 3-year period, there's been an average annual return of 1.5%. Over the 10-year period, there's been that average annual return. My eyesight is terrible, but of 4.5%. So over a 10-year period, even including this rough period we've been in, the average annual return of the portfolio has
So
been
that would be a
4.5.
net gain of 4.5.
Yes, correct.
So we've recouped all losses in that scenario in.
The further out we go, right, which is, so the further out we go, we're looking at positive returns from the portfolio from a cumulative standpoint, which is the reminder that as a long-term investor, right, if we were just investing with a year in mind or a week in mind, it'd be like an abysmal picture that we're looking at. But as long-term investors, the reminder here is even with the tough returns of the market presently, the portfolio still has generated a positive return over the last decade. So that's how you read that. These are annualized returns. So the average annual return over a 10-year period has been 4.5% net of fees for the portfolio.
The plan in February, the long-term return goal was 7.1%.
So that's
the
the
40-year, or is that the 10-year?
we calculate it as a 10-year. So 40 years is tough to know what's going to happen in 40 years, but it's a 10-year average. Yep.
Okay, so this is reflecting all the changes that occurred due to 2022. So
Yes.
this is the changed.
Yes.
Okay.
Yeah. And if we were to look at this exhibit this time last year, the number would have been significantly higher. We are still in the midst of a bull market, and everything would have been essentially additive to the far right-hand side. So everything has come down on the right-hand side because of the losses we've seen over the 1-year period, as well as over the year-to-date period, but it's still positive. That's the key takeaway there.
And the projection 4.5 is based on what parameter where you see the recession ending soon or prolonged recession?
Yeah, so the 4.5 is an actual rate, and
Based on the current market.
yes, based on the current market environment. So this is where it becomes really tough with the recession. And I'll say here that the financial media and the investment industry doesn't always do the best job of kind of bifurcating the human cost from the economic cost, right? So in a recession, there's definitely going to be a big human cost. There's going to be layoffs. I think it'll be a wake-up call for some of these folks that have been quiet quitting and some of the strange trends that have been going on in the workplace. But, for a period of time, there'll be a contraction with certain segments of the population. But that disruption from a market standpoint, this is where it's weird, could lead to very significant windfalls or opportunities because that's how the market operates. It's zero sum. So if there's a loss in one segment, there's a gain in another segment. So a recession doesn't necessarily mean that the market will go down. A recession could actually mean it's the reset that the market was looking for to kind of rebound. So I think what essentially triggers us into a recession, which I think is the Fed, if it is the Fed and the Fed finally does pause on its interest rate policy, the market will likely view that very positively and it will likely rally as a result of that. But again, I would say closer to being in the recession or in the midst of the recession, we'll have a clearer idea of, okay, what's going to be positive as a result of the recession from an economic or financial standpoint, and what's going to be more negative as a result of that. What would be super positive, but we don't know at this point where the Fed is leaning, would be if the Fed realizes that it's overcorrected with interest rates, and we see either a pause or a slight reduction in interest rates. I think the market will significantly rally. because once again, fixed income is going to do really well. Equities would hold up pretty nicely, particularly on the growth side of things. So again, I think the closer to the springtime, which is the projection for when we're in a recession, the easier I think it will be to kind of pinpoint what segments of the market will do well and what segments will probably be penalized for a little bit longer.
Because if you remember, in 90s, we were in the kind of the same scenario, and towards the late 90s, everything rebounded back.
Yes, exactly. And
Exponentially.
yes. Yeah, we've been really spoiled following the financial crisis. So typically in an economic cycle, you have a period of expansion, then you have a period of contraction, and then contraction leads to expansion. It's the boom-bust cycle. What we went through following the financial crisis was this inability to wean ourselves off lower interest rates, because it was just a really, really simple way to lever up, whether you're a company, whether you're an individual. And we saw segments of the market like technology, biotech, in particular do very well as a result of that. So there might be more of a return back to old style economics, which is, okay, interest rates don't go back down to zero, they're above zero, and we have your normal booms and busts, as opposed to like a prolonged, we had a decade plus bull market, I should say, a decade plus bull market following the financial crisis of 2008, which was really spurred on by low interest rates.
Thank you, sir.
So as we look at the various segments of the portfolio, literally no surprises to highlight here. Fixed income has gone through its challenges. The performance of the composite is in line with the fixed income market. The FD composite, a little bit behind, the benchmark, but once again, no real surprises from a manager performance standpoint. The alternatives asset composite hedge funds, segment of the market that has held up relatively better in 2022. And then real estate, our real estate exposure is REIT, real estate investment trusts. These are daily traded stocks of real estate companies, real estate corporations. So naturally, there's been a lot of correlation with what we've seen in the marketplace. So no surprise that REITs have performed in line with the market. And then as we typically do, we'll highlight the top performers and the bottom performers. Again, this is such a strange time that we're in, where we can say, look, this manager was down 16%, but they're a top performer. This manager was down 24%, but they're a top performer. So again, it's all relative in this particular environment. And the important thing is having managers that can protect on the downside relative to the broader market. This table here just gives us a quick reminder of some of the actions or some of the meetings we've had up until today, where we talk about, we start off, around a year ago, we had an Investing 101 overview. Quick reminder here, at the end of last year, we did present the initial asset allocation. That was approved, and then the investment policy statement was updated during the first quarter of this year. We did transition from an ETF, an exchange traded fund, into an index fund just for fee savings during the second quarter. And then the last meeting we had, we were given direction to move forward with indexing portions of the portfolio, which we have resolutions to go over today to kind of finalize. This exhibit here just points to the fact that the portfolio is currently in transition. There are asset classes that we are underweight in, and there are asset classes where we're overweight, and that truly is just a natural progression to the approved asset allocation. So that sums up the market environment and the portfolio and how the portfolio is holding up. I'll pause and see if there are any questions before I go into section B, which is the asset allocation transition plan.
Probably a difficult question to answer, but how bumpy a ride for the next 6 months? And when do you see kind of leveling off or rebounding?
So I'll say this: it will definitely be bumpy. I don't know the extremity of the bumpiness, where you could have a left tail event, something geopolitically happening in Russia, Ukraine that kind of exacerbates the bumpiness that we're seeing in the market. But right now, things are continuing to trend downwards. Commodities should be hit negatively as we think about bumpiness and demand coming down a little bit. The one thing that kind of makes it great, we've got midterms and then we have another presidential cycle coming up. So that could also lead to, depending on who the nominees are and their platforms and so on. So that I'll put it this way, we can go from a little bit bumpy to extremely bumpy depending on those factors, but we will not avoid bumpy over the next 6 months. So I'll stop there and just say that it's going to be a pretty tough ride. Okay.
I have a few questions.
Yeah.
It showed that our assets in the REIT market were down 29%.
Yes.
Is that included in the asset class for real estate that you showed at the beginning for 2022 that actually had a positive 3%?
No, so REITs, so when we think about real estate, there's different ways to access real estate, and what we have in the in that map is it's private real estate. It's core open-end real estate that's measured against, it's called the Odyssey Index. So that's where we are transitioning our REIT allocation to. REITs are real estate investment trusts. These are the stocks of real estate companies that trade on an exchange. Right now, as the equity market's going through a lot of volatility, we're going to see that same level of volatility or similar level of volatility hit the REIT market. But we're not seeing that hit the private real estate market because it's not mark to market on a daily basis. It's a slightly different asset class, even though they're both in real estate. So as we talk about the asset allocation and as we talk about real estate, our exposure will be to what we call private real estate. And the private real estate has performed exceptionally well. That's in positive territory. REITs are not in positive territory.
Okay. And has the strengthening of the US dollar continued even despite the changes in the European policies in regards to flooding market cash?
So the dollar, this is a pretty good rule of thumb. For whatever anyone says about the US, whether internally or externally, anytime there's a crisis, everyone floods to the dollar because there's still, for lack of a better term, there's more uniformity, there's more dominance, there's more widely acceptance of the dollar as this currency of last resort. So when the rest of the world is in crisis, foreign investors, you'll typically see them pile into the US dollar a lot more. So it's a long way of saying in this environment, we are continuing to see the US dollar trend towards being a lot stronger than other currencies. And, you can look at it from a couple of different angles. Interest rates have gone up. That's painful for us. But then if you're a foreign investor and interest rates in the US have gone from 0 to 4%, basically, you're going to want to buy more dollars or pile into US bonds or US assets as a result of that. So again, the US dollar will continue to likely strengthen in this environment because, frankly, there's not another alternative that's as strong. You mentioned Europe or the Eurozone as an example. The Eurozone, for I think the first time since the Euro was rolled out, you were looking at, a level where the dollar was so much stronger than the Euro. We hadn't seen that before. And as a proxy, the pound, I can speak a little bit more about that. The pound has typically been at 1.5 or 1.6 per dollar. It's 1 for 1 right now. So Europe Europe's going through its own issues. I'll put it this way, there's major conflict, Russia invading Ukraine. You have, Brexit, which has proved to be again, a hissy fit decision that was not a smart one. For all the issues we have in the US, from a financial, economic, and institutional standpoint, the dollar still, is an attractive currency for those reasons. Yep.
And then the last question is, historically, value stocks only outperform growth stocks when inflation is over 1.9%. And when we're looking at the allocation of our large cap investment with a high purchase, are we looking at the realities of how long we think that inflation will be over 1.9%? Because I mean, this is a long-term
Yep.
investment, and if we can do a short-term investment with that flip-flop with inflation, how quickly can we reallocate as needed when that inflation comes back down?
So I'm smiling. I'm glad you asked that question. So what we'll be recommending in the asset allocation, what we have recommended, I should say, and what has been approved has been a core approach. So you have value investing, which is your established companies. You have growth investing, which are, for lack of a better purpose, your tech or biotech companies. And then you have a core index. The core index is basically a blend of value and growth. And the beauty of being in a core index is we don't have to time which cycle is going to do well. Core will naturally gravitate towards either growth or value and take away the risk of us trying to time a cycle and get it wrong. So that's really the approach that we'll have, and that's the reason for that approach. So as we talk about the asset allocation, once again, this slide here does a good job of recapping changes that have been put forward. So if you look on the far right-hand side, the arrows going down in red point to areas in the asset allocation that we reduced within the approved asset allocation, and then the arrows going up in green point to the areas that we increased as a result of the new asset allocation. So you'll see that we brought down the overall fixed income exposure a little bit. We also increased our equity exposures both on the US and non-US side. Hedge funds we eliminated, and then REITs we've eliminated, but we add global infrastructure, private equity, and then real estate core. Real estate core, once again, these are private real estate investments. From an expected return standpoint, the expected return does spike up, and the volatility spikes up a little bit, but definitely from a risk return standpoint, more favorable, maps more favorably in the approved asset allocation. There's a lot going on this particular page, but just to keep things really simple, you see what's in red. Red points to what will be eliminated. What's in green will point to what's going to get funded, and what's in blue points to new additions in the portfolio. So this is really just for your reference. I don't want to confuse anyone by going through this very busy document, but it's a good reference point. And as fiduciaries, again, it's just that roadmap to the moving pieces in the portfolio. This is a much easier way to digest all the information I just showed you on the previous slide. So what's the takeaway here? The takeaway here is we will rebalance away from the REIT index. We'll rebalance away from the Core Plus strategy, and we will make a purchase of $15 million into a listed infrastructure strategy, which will be a placeholder for private infrastructure in the portfolio. The reason why we're going into listed infrastructure first is simply because infrastructure, there's a lot of demand for infrastructure assets presently, private infrastructure assets, rather than be out of the infrastructure market completely. We'd rather go for proxy allocation, which is the listed allocation, and as and when capital gets called from private infrastructure, we'll have an area to pull it back from. On the real estate side of things, we are firstly just going to pare back and sell an allocation to the REIT exposure we have with Vanguard, and we'll transition that into REIT exposure with Fidelity. The REIT exposure is also proxy exposure right now. We are looking to go into private real estate, but that will take a while to actually invest in. So that's why we're simply making a transition across the REIT exposures for cost reasons. And then on the US equity front, this again just answers the question around core value and growth. You'll see here that we actually phase out the value exposures, the growth exposures, and you'll see here that we have a large cap index fund that we allocate to. That large cap index fund, again, is a core fund, so we're not looking to time any styles. We're really just looking to have exposure to the market and then naturally gravitate to the styles that the market is rewarding and favoring at any point in time. In addition to the US large cap option being added here, you see that we have on both the mid cap and small cap side the addition of mid cap and small cap index exposures as well. And then as we think about future rebalancing, so this is for a later date, phase 1 and phase 2 is happening presently following your approval today and the reading of the resolution. The next phase, future rebalancing, will be dependent on when we receive the funds from Prisma. We're looking at middle of November to receive those funds. When those funds are received, we'll have a more detailed action plan rolled out for these assets coming in from Prisma. And then once again, just to set expectations for 2023, these are areas where we will be adding managers, specifically actively managed strategies to the portfolio. You know, I won't go through everything here, but we see the asset classes, and once again, private real estate, global infrastructure, private equity, these are areas of the markets that we feel over the long term will help from a diversification and correlation standpoint. So any questions over what I just went through on the transition plan?
When you talk about active management
Yes.
of those different classes,
Yes.
what is the frequency of that active management? Is it set based on an individual and their knowledge, or is it set based on percentages for the company? What's the framework of that?
So that will definitely be a manager selection decision. So as we profile and bring managers to you for consideration, what you just mentioned will be a manager selection decision. Some managers will be more active, higher tracking error. Other managers will be more steady Eddie, and we'll really give our recommendation as to who we think the best manager would be and what style would be best. And we typically favor fundamental managers, those that are really going through the financial statements. It's not just a quantitative screen going through everything. It's not just a computer saying, look, sell this stock or buy this stock. We do like managers that have that human element to stock picking, so that's a preference we typically have. But again, as we hone down a list of managers to recommend, take a further look at, we'll explicitly state the differences in styles and the pros and cons of those styles and how we feel that they would fit into the long-term plan of the portfolio.
For the reallocations, what is the time commitment to keep the funds there?
So for the reallocation, I would say that for some of the asset classes, in particular infrastructure and real estate, where for infrastructure we'll have listed infrastructure as a placeholder, REITs are still there as a placeholder. It may be a couple of quarters until we have managers in the real estate and infrastructure side that can actually take our assets. So in some areas it'll be a couple of quarters. On the private equity front, we'll cross that bridge when we get to it, but some areas will be very easy. We'll literally have, let's say for mid cap and small cap, during the first quarter, I think it should be pretty straightforward to have good managers in front of you, and then we make a selection. Other asset classes, again, depending on the queues, the availability and capacity of managers, it may take a couple of quarters.
Okay, but it's not a multi-year commitment.
No, definitely not. Now, on the private equity front, private equity will take, that will be a multi-year commitment in the sense of you choose a manager and it takes a number of years for them to invest the money, reap the rewards hopefully, and then return the money to you. But we won't be in limbo for a number of years moving to the asset allocation. That will be a couple of quarters. And I would say it's typically from the approval of an asset allocation, it can be anything from like 18 to 24 months, depending on
Project.
availability of managers and so on. So we're moving at a good clip, and we won't be out of whack with the asset allocation for a significantly long period of time.
Got it.
But just to clarify, the current funds moving to it, there's no lockup provisions on these, we're flexible
No.
in the funds that we're going into.
Correct. The index funds, the beauty of them is the flexibility, the liquidity, transparency. So there will not be a lockup with any of them.
And is it too early to have a projection of what our earnings could be?
For 2022? Or
Yeah, yes. I know it's $1 million
I
question.
mean, the only thing I could say here is for 2022, we're in October, November and December. There's two things that could save us. I don't even know the magnitude of. I would say that 2022, it looks like it's going to be a negative year unless we suddenly get 2 months of 20+% returns, which stranger things have happened, but it doesn't seem likely. So I would say that this year will be a negative year, most likely. Whether it's in the high double digits or low double digits will be dependent on how successful like Black Friday earnings season and some of the other reports coming out will be. So that's going to be the key thing. It's not whether we're positive or negative, it's how negative. And again, I think Black Friday, Christmas spending, earnings, the IMF just came out with a pretty chilling revision of growth for 2023 globally. So anything that can come out to kind of combat those predictions will hopefully push more positivity in the marketplace. But 2022, it really does look like a negative year for us. In the context of the market, I would say that we've been really, really spoiled again following the financial crisis, where before the financial crisis, there were years where the market would go down and there were years where the market would go up. But we went through like this 10-year period where the market just went down like twice. But the market, the S&P returned 30% in one period of time, 28% in another period of time. So I think we got conditioned to forgetting that the market can lose. And this year is a reminder that the market can definitely lose. But 2023, the prediction is 2023 is a reset. So the reset would be the recession, and then it allows the Fed to kind of take its foot off the pedal, and the market factors can kind of establish themselves once again.
Okay.
Okay.
And I just wanted to note that Director Guzman is here, Chair, and we do have a quorum.
Okay. Thank you, Kwaku.
Thank
Any
you.
other questions? Okay. We have two action items, so let's proceed with those two action items. Action item 1 is Resolution R152/2022 to reallocate real estate index funds between index funds and reallocate from core fixed income fund to a global infrastructure fund in accordance with the investment policy statement. Great.
Yeah, thank you, Chairman. The resolution as presented rebalances the investment portfolio to move approximately 3.5% of real estate funds held in Vanguard ETF to a Fidelity real estate fund. An additional 2.5% of the ETF will be reallocated to the new Global Infrastructure Fund, Cohen and Steers, with the residual balance, which will be held in cash for current operation needs of the pension. And also, this resolution completes the reallocation to the Global Infrastructure Fund with a recommendation to liquidate 5% of the core fixed income fund held with Fidelity, invest those funds also with the Cohen and Steers Global Infrastructure Fund. These recommendations are consistent with the target asset allocation. We appreciate the committee's vote to advance the resolution forward to the Board of Trustees.
And that would be at the board meeting next week, correct?
Yes, yeah. Yeah, I could cover. Resolution 153 also presented provides the actions to rebalance the equities from the existing managers to a series of listed funds with Bank New York Mellon. Specifically, the resolution liquidates large cap value equity managed by Barrow Hanley, the existing BlackRock large cap growth, and a portion of the over allocation of the core fixed income fund, and allocates these funds to the BNY AFL-CIO Large Cap Index Fund. And the resolution also recommends amounts held in the small and mid-cap manager New South be moved to a combination of the BNYM AFL-CIO Mid-Cap Index and Small Cap Index to access each of these equity asset classes through a passive listed fund while additional transitional manager searches continue. Yeah, we appreciate the committee's vote to advance the resolution 153 forward to the Board of Trustees.
Thank you. Can we take these in global, or we have to take them separately?
We can take them in global.
Okay. Then I would ask maybe we have a motion to approve resolution R152-2022 and resolution R153-2022.
So moved.
We have a motion. Do we have a second?
Second.
We have a motion and a second. Any discussion? Any public comment?
No public comment? Public comment? Oh, okay, no
No
public comment.
public comment. All in favor, please indicate by saying aye.
Aye.
Any opposed? Motion carries. Now, I think I need a motion to enter executive session.
Yes.
We have a motion to enter executive session. This is in reference to a disability retirement allowance application.
So moved.
Second? We have a motion and second. All in favor?
Aye.
Aye. Motion carries. Now we move into executive session.
Stephanie will present, we'll close the doors and.
Let me go get some coffee real quick.